This is your LMAX exchange technical update for Friday, August 4th, 2017. Eurodollar. So no technical signs of reversal just yet in the euro, with only the market warning of a reversal given the extended studies both on the daily and more extended studies on the weekly chart. At this point, the market could still push up towards the 120 area given that we haven't seen a reversal just yet, but at the same time, additional rally should be very well capped in the short term in favor of an overdue healthy correction to the downside. Right now, the key level of support to watch on Friday comes in at 1786. That's the low from the 1st of August. A break and close below that level would suggest that the market is finally looking to roll over in favor of some form of a correction. Overall, the break that we saw the other week above 117.15 does suggest that we could be seeing a longer term structural shift and a base in the euro, but again, for the moment, short term, with technical studies so extended and the market having run so far and fast, there is risk building for a bearish reversal. If the market does close back below that level that we talked about at 1786, it could open the door for a more significant pullback into the 112 to 114 area. Sterling dollar. So cable once again pushed up to a fresh 2017 high on Thursday, but as we've highlighted, the market hasn't been too excited about pushing to fresh 2017 highs into this run up, and finally the market rejected that high, putting in a bearish outside day formation, a convincing one in Thursday trade. This sets up the possibility for a resumption of declines here and an extension to the downside over the coming sessions, potentially all the way back down towards the 128 and into the 127s. Overall, the outlook here on a medium to longer term basis is increasingly constructive following the breakout back in April above a range resistance at 127.75. And so if we do see setbacks towards the 128s and 127s, they're expected to be very well supported ahead of a resumption of gains, ultimately back up towards a key medium term measured move extension at 135. Dollar yen. So dollar yen, as you can see here, has been range bound for most of this year, with the market once again most recently being well capped a few weeks back in early July above 114, opening the door for this latest round of setbacks within this range trade. This does expose deeper setbacks in the sessions ahead, potentially towards the 2017 low that was seen in April, just shy of 108. Any rallies that we do see should continue to be well capped, and only a pushback above 114 would really compromise the bearish outlook right now for dollar yen. Euro Swiss. So Euro Swiss is raced up to fresh multi-month highs and its highest levels since January of 2015, following the breakout that we saw recently above a critical resistance point at 112. But this does leave technical studies here exceptionally extended, and again warns of the need for, at a minimum, a form of consolidation, or we potentially could see the market pull back for a correction to the downside before it considers extending this run of gains. There is a shift now in the structure following the breakout above 112, which does point to and suggest a move back towards a retest of 120, but in the interim, again, there could be a pullback over the coming sessions towards that previous resistance now turned support at 112, where the market will finally look to put in some form of a higher low and continue to the top side. Right now, pay attention initially to the support that we saw at the low at 1460 about from Thursday. A close below that level would potentially warn that the market is looking to stall out and reverse course. Any additional upside to fresh 2017 highs that we do see beyond the recent highs around 115.25 are seen limited right now, again in favor of either a consolidation or correction to the downside. Aussie dollar. So Aussie recently stalled out by its fresh 2017 high, also a plus 2-year high at 80.66, and since then the market has pulled back and been slowly consolidating, but there is signs here that the market could be wanting to roll over a little bit more before potentially considering fresh upside. And so if we see a breakdown below what is now viewed as critical support at 78.76, the low from the 21st of July, if we see a breakdown and close below that level, it could set the stage for a more significant pullback towards the 72 to 73 area. So that's where the focus should be right now with Aussie dollar. Dollar CAD. So dollar CAD has recently pushed above some important resistance on a short-term basis. The breakback above 125.75 does potentially suggest that we could see a more decent correction to the top side, taking us back up towards the 127 to 128 area before the market considers the possibility of a resumption of declines. We've seen intense declines over the past few months since the market put a 2017 high in back in May, just shy of 138. And so ultimately the pressure now is on the downside, but the correction that we could see could extend to the 127 to 128 area before the market considers a bearish resumption. If the market is unable to do so and continues higher back above 130, then we could be looking at a material base here in favor of significant gains and maybe a resumption of a longer term uptrend in dollar CAD. So a bit of a critical inflection point right now for dollar CAD. But there is scope now for the market to trade a little bit higher at a minimum on the short term. Kiwi dollar. The New Zealand dollar is recently stalled out by a 2017 high, also a plus 2-year high for this market after pushing above a critical psychological barrier at 75. There have been signs of the market potentially wanting to roll over, but it's going to take a close below 74 right now to strengthen that outlook and potentially open the door for deeper setbacks towards the 71 to 72 area before the market at that point considers the possibility of a higher low and continuation of gains or potentially deeper setbacks. SPX 500. The S&P 500 has recently traded up to another record high the other week, up just over 2480, which is a key measured move extension following the breakout above 2400 earlier this year after the market had consolidated 80 points between 2400 and 2320. And so now that it's met that objective, it makes sense to see a bit of a consolidation here before the market considers its next move, which very well could be a continuation of this very intense uptrend that we've seen over the past several years. Short-term support for this market now comes in at 24.58, looking back to the low that we had seen on the 27th of July. So a daily close below that level at a minimum would be required to alleviate immediate topside pressure, while right now it's looking like a close back below 2400 would be required to suggest the onset of a more significant bearish reversal and potential top, at least interim top, in this market. Gold. So gold is a market that has been very choppy over the past several months, but it also has been very well supported on dips, making higher highs. So we did see a higher high back in the month of June, with the market trading just up above the previous 2017 high that was in place in April to 1296. And setbacks were most recently supported ahead of 1200 and ahead of this next upside extension that we're seeing right now. So the market should continue to be focused on pushing higher through 1296, the 2017 high, and up towards the next major resistance point, which is the 2016 peak at 1375. Any setbacks that we do see over the coming session should continue to be very well supported ahead of 1200. Ideally, this round of setbacks, if we do see it extend to the downside, ideally supported ahead of 1230 in favor of a higher low.